you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Nick Gartside, manager of the JP Morgan Global Bond Opportunities Fund. Hi Nick. So we're here today to talk about the global outlook for bonds, and we should probably start with what's been going on this week. We've seen a massive spike in bond yields in the US. Is this the beginning of the end?
No, in a word, it's not. So think of the moves in bond yields very much as a correction, not a reversal. And what's driven that correction is positioning. So, just think about it. There was a backstop bid for bonds through the ECB. It looked like a one-way trade, so positions are very, very concentrated. So there's a little bit of unwinding of that. The second thing, and the big thing, is of course that there's now some inflation back in the market. You can look at inflation expectations, and they've gone up. So inflation won't be super high, but we're not in a realm of deflation, and that's the big difference.
And you talk about we're not in a realm of deflation. Is that for the US? Is that for the UK? Is that for developed markets in general?
It is. So the critical one to look at is the Eurozone. That was the really big worry, that the Eurozone would slip into this downward deflationary spiral. ECB QE seems to have broken that. And for other markets, the key indicator to watch is wage inflation. And ultimately, think what a big economy is. It's you and I going out shopping, you and I as consumers. And we will spend more when we get wage increases. Wage growth around 2% in the US and the UK now, and that's good. That is the indicator that should be on every bond investor's checklist.
So obviously US QE coming to an end, Eurozone only just really beginning its QE, Japan I think would probably go for a third lot of QE. How does all this money coming into the global market create opportunities for you or dampen opportunities for you?
Well, you hit the nail on the head, Emma. And when you look at Japan and when you look at the Eurozone, what the central banks are doing there is buying more bonds than are being created. So ultimately, that's another reason it's a correction, not a reversal. What it also means, though, is a lot of those government bonds look pretty pedestrian in terms of their risk-reward profile. What we think investors should be doing is looking at corporate bonds, investment-grade corporate bonds, high-yield corporate bonds, and then on a much more selective basis, emerging market debt.
And within those fears that you've just talked about, where are the real opportunities for you? Is it sector-driven? Is it issuer-driven? Is it very much picking one by one?
It's certainly picking one by one, but I'd pull out a few themes there. One theme is financials. And again, think what's happening now. You've got economies deleveraging still, banks raising lots of equity. So that's good for the debt holder. The other theme is probably Europe. Again, think in Europe, you've got all these government bonds with a negative yield. You've got economies that are now growing. So there, the risk is default rates are lower, not higher. So things like European high yield, again, should be finding its way into investors' portfolios.
Nick, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.